We're gaining momentum as we get maybe almost 500 people on this webinar. So I'm going to just talk just briefly about what we're going to be covering. The two most important things, getting in right and getting out right, will be talked about. And I'm going to take you through some of the journey of what I've been through over the last 30 years and how I've had to refine that process, and never assuming I'm right. Whenever I start a project, it's basically always started with a clean slate. It assumes that I don't know a thing, and that allows me to have the purest result I can possibly have. And this time, honestly, that was a very important thing, because one of the chapters that was done at the end of this report completely changed what I am about to do. And so I guess that's a kind of a good statement about the purity of the attempt to figure out what to do in California. We're going to talk about investing versus speculating, and the concepts of undue stimulus, reverse stimulus, systemic stimulus, transactional stimulus, and 5 key questions that you guys have to ask yourself. My first attempt to figure out what was next in a market was in Grand Junction, Colorado. I'm 32 years old. It's 1984. I have a friend's dad who lives in Grand Junction, and in 82 they had an experience on May 2nd called Black Sunday, where ExxonMobil pulled out, shut down their $5 billion project, and threw about 2,200 people out of work. Well, that created devastation for most people in the area and created quite an opportunity for this investor. So that was my first attempt at taking a look at a market and seeing if I could time getting in correctly. There wasn't a rush to get in. For one, there was one thing about getting in is that you can get in a little late. That recovery took a long time. I was in escrow negotiating for that deal something like 9 months, and there was no rush on my side, and the longer it waited, the more motivated FHA got. I bought fourplexes for something around a 75% discount off of their former sale price. And so that was my introduction to the word short sale. Although these were foreclosures, there was a lot of people trying to get less for their property than they owed. The only question I had to ask was, will they ever build another fourplex in Grand Junction, Colorado? I was buying them so cheap that I thought that that really was the only question. Are they ever going to build another fourplex? And the day they do, I'll have made a lot of money. The other question actually after I got into it was, could I survive until they did build one? And the answer was yes, because I was investing in this case. I had bought fourplexes at 30% of what it cost to build them, and they cash flowed at 50% vacancy. And so that qualified as an investment. Over the last few years, the hedge funds have basically asked that same question when they were investing in California, Nevada, and Arizona, or wherever they end up. Are they buying it below replacement cost, and is somebody going to build another one someday? In a few years later, in 1988, I had a chance to buy 50 lots from the Bass brothers. The lots were in Palm Springs. I'm now 36 years old. It was kind of a sleeper. There was a boom going on. These 50 lots were sitting there dormant. I passed by them as I drove back and forth from a project we were involved in. So I made a phone call, and I got to buy these 50 lots. I was very fortunate that the man gave me a chance to buy them with nothing down, but I had a $2 million loan that was due in 6 months, no payments. Fortunately, I sold the lots inside of 6 months. I made $1 million. Here's a good question. Was that investing? The answer is no. It's pure speculation. That just happened to work out. I had a 6-month note. It was all due and payable. I had lease land that was running out of time. I had the type of inventory that was unsellable a year later. A year later, you couldn't have sold that. And there was no revenue possible from the land. It was a pure speculation that happened to work out. That was a different animal than what I did in Grand Junction, Colorado. In 1990, I experienced getting out late. In 1989, I built 7 custom homes in a gated area of Palm Springs. I thought it was an investment. It was not. It was a very ill-timed speculation. In a downturn, you don't want to end up with what I ended up with. High-priced homes that won't rent and that have a payment of $3,000 a piece. For 30 months, my world froze. I've never experienced this type of thing. California wasn't supposed to go down. And so literally every waking moment, every dime was devoted to solving this mess. I was so busy sending money to this project on a monthly basis that I was really unable to take full advantage of getting in the 90s downturn. I learned that getting out in time was much more important than getting in on time. In 1997, we wrote our first report, and it was about getting in on time, getting in right. The key points were that we saw that when construction improved, it spurred employment. Increased employment spurred migration, which spurred demand for housing. So those were the dominoes that we expected to happen when we could see a comeback coming. And doing the math, I thought we could probably double in price, and it turned out we tripled, and then now we know for spurious reasons. It shouldn't have happened, but it did. In 2004, pretty much at the tail end of the boom, but with enough time left in this particular area, we bought 93 lots in Rosamond. Bought them about 2 years before that, and we sat there and waited. And this was interesting. Tony Alvarez and I had a conversation in about 2003 or 4, and he was interested in selling all of his stuff, and I'm dragging my feet on these 93 lots. Somebody had a $3 million investment in those lots, and we bought them for $270. Because we had better timing, we made a fortune on those, and they lost a fortune. That's how important timing is. We bought the lots for $3,000 a piece, less than 10% replacement cost. We built a tract of single-story small homes intentionally. I had an original partner who wanted to build 2-story houses on a 2,800 square foot lot. I didn't think that would be investing. I thought that would be disastrous if it didn't turn out right. So I stuck with the inventory that I want. We unfortunately sold everything, but had I been stuck with it, I would have survived. We got out just the nick of time, so it was a very well-timed investment. Not a very big speculation in my way of thinking, but we also had some good fortune thrown in there because we did get out in time. In 2004, we wrote a report called the California Countdown, and it was a report that was written to give us a kind of a timetable of when to get out. I knew it was early, but I knew that we were going to have some choices on where to take our chips. We suggested that you get away from California. At that point, I viewed it as a pure speculation, and head to Texas, which I viewed as a conservative investment. The keys to the report were the maturing of several key charts and affordability being the most important. And this is what's interesting, as I've learned more and more about the charts and what I think is absolutely true, you always find there's a hybrid or there's another thing to explore. In 2005, we wrote the California Crash, and that report really had urgency to it. Get out of California now. Affordability had reached that magic number that I believe in at 17%. And then, of course, in the next year, it went down to 11. Prices continued to go up. As we found out, those last pile of equity gains were pure speculation, and they would be given back and more for the people that continued on that path. We know that ridiculous financing stepped in and allowed that explosion to go way past where it should have stopped. And it really created in our industry a Great Depression event. I don't think I've ever seen anything like it. I don't know that I'll ever get to see another one like that in my lifetime. I hope I don't. And many people are still not recovered fully from what went on during that time frame. So we come to this new report, Proceed with Caution. And there's some questions that you probably should ask yourself. For me, I'm selling some of my California properties in 2015, and here's why. I'll give you an example of what was purchased and some of what I've got. I've got a single-family home, was purchased for $60,000 in 2009. Took about $20,000 to repair it. Today's value is $225,000. It's been rented faithfully for $1,200 for the last 5 years. When I bought it for $60,000, it was absolutely an investment. At 225, at 1,200 square feet in a so-so area, what is it now? I consider it a pure speculation. When I sit in front of that house and I ask myself, would I exchange $225,000 of hard cash for that? The answer is no. It's already gone up over 300%. It was a great investment. What if I waited? What if I got 275 for it? Would it be worth the risk of getting the upside? At 275 and 27.5 closing costs, I'm going to net something around 247.5 minus repairs. So I really had to ask myself, was it worth hanging around for the next 20% upside? Is there something I might be able to exchange that would be more investing than speculating? We'll talk about this at the end of the book, but I've kind of discovered a hole in the market that I've never seen before. And it was on a chapter we've never done before. And based on that discovery, I feel like what I'm about to do will double my return, allow me to change speculation for investing again, and allow me to change inventory in a so-so area to a good area. So I'm very excited about having figured this out, and it completely changed what I was about to do. So for what you own and where you own it, the first question is, are you speculating or investing at this point? And these are the questions you should ask yourself. Should I get out or let it ride? Should I get out and go somewhere else? And by somewhere else, I mean, is there another world of investments you would feel more comfortable with? Interesting day today. If you look at anything in investing, stock market down, a lot of people change and go to other worlds that they're not familiar with. We see that all the time when people come to us and invest in trust deeds. Some money is very temporary. They chase the next best thing. So maybe that's something that you think you would be good at or have done before. Do you get out and just hide? Do you put your money aside and wait for a better opportunity? Maybe you stay in and keep what you have. One of the things this report is going to do is going to show you where that's very sensible to do. So I have some properties that I will keep and hold, and I consider those investments. Is it possible to stay in and switch inventory? Can you go somewhere else where you've exchanged your speculative seat to an investment seat? Could you change the types of inventory that you own? Let's say, could you go from residential to residential in another area, or could you go from residential to commercial? So all of these things are up for grabs in the next year for me, is trying to figure out exactly where to land. I've already got my first home vacated. It's up for sale in the next week, and I'll begin my own plan in where to transfer and become an investor again and not a speculator. What's the difference between investing and speculating? I think it comes down to the difference being able to survive a surprise or a timing error. Every time I was speculating and I got hurt really bad because I was holding exactly the wrong thing. Which of those do you prefer to do, speculating or investing? And honestly, I think most California investors are speculating and you don't recognize it. Can you get rewarded for speculating in California? Big time. That 50-lot deal that I did in Palm Springs, made $1 million in 6 months. Yes, very rewarding. Can you get crushed if your timing's off? Absolutely. That 7-house deal in Palm Springs, I gave it all back. That's kind of what you want to avoid. And at 62, I can afford to be an investor. I can't afford to be a speculator. And what about you? I bet you probably care about your money and your progress in the last few years as much as I do. And I'd like to keep my chips, and I'd like to continue to make them grow. That's the gist of the 2015 Proceed with Caution report. It'll help you make this transition with more precision than you'll be able to do on your own. We'll take a look at the chapters that we're going to be discussing. First chapter is expectations and false explanations. When we went into the first month of 2014 and looked at the charts, there was definitely an expectation that 2014 would turn out to be a very good year. It didn't turn out to be true, and when it didn't turn out to be true, we're given explanations that I'm going to debunk in this chapter, because it's really important that if you have something that wasn't supposed to happen, as a matter of fact had never happened before with a set of charts that were in place in January 2014, I want to get to the bottom of why it really happened and not believe somebody telling me it's these reasons. So we spent a little time talking about the reasons we were given and why it's absolutely not true. In the second chapter, we'll talk about what actually happened. We'll go through the charts of significance in 2014. We'll take a look at exactly what happened, and we'll see if we can figure out why they occurred. The next chapter is the concept of reverse and undo stimulus. We've never approached a report from this perspective, and to be honest with you, it's changed the accuracy of the outcome, and it changed my mind on what to do with my own money. So this idea of concept of reverse and undo stimulus comes from the appraisal world, and talking about the market value and the definition of it. And it basically gets down to a transaction that is free of undue stimulus. What we have sometimes in our real estate market is we have two things. We have reverse stimulus and undue stimulus, but we don't always contain it in what's called transaction stimulus. That's what the definition in the appraisal world is talking about. Do we have something in this transaction that's a false stimulus, like a nothing down or a 0% loan, things like that? But more important, and this is the thing that I've really concentrated on, is do we have systemic stimulus? Systemic stimulus is when you take somebody that doesn't have an income and you can pretend that they do and the lender buys it. Stated income loans were a systemic stimulus. In 2012 and 11 and 13, we have reverse stimulus. You have a 700 FICO score and you can't get a loan. So systemic stimulus is really important. And as we go into the next chapters, these are the questions that we're going to be asking for the first time of all these topics we've researched over and over again. We're going to ask these questions. Number one, was it reverse stimulus or undo stimulus 2014 versus 2013? So we're going to be able to take a look back and say, okay, was 2014, let's say, more negative or more positive than 2013? Will it be reverse stimulus or undo stimulus in 2015 versus 2014? The next question is, will it be reverse stimulus or undo stimulus 2015 versus an historic perspective? And this is where this becomes important. Let's say lending is looser in 2015 than it was in 2014. Okay, is that a big deal? Well, it could be, but what if in historic perspective it's still very restrictive? And so that's why that third question is very important. Number four, is the current direction of reverse or undo stimulus likely to continue, diminish, or change? So that's very important in all these categories, is to decide where the direction is. And number five, how important is the category to price and sales movement in California? So in each of these chapters that's following, we've rated it a category. And a category 5 is the highest category, which basically means that if you have a problem in this category, it could be more important and carry the weight and send the real estate market in a different direction. Undue stimulus, this was the first question that we've gotten. Undue stimulus is something that is artificially stimulating the real estate market. Undue stimulus was stated income loans. Undue stimulus would be, let's give $8,000 of buying credit to somebody in 2010 and 2011. Well, that temporarily changed the sales chart. And I think that's the important to recognize, is that in each of these chapters we'll discover that undue stimulus plays a part in where we ended up. And you have to be very careful, because if that undue stimulus is about to change directions, you want to know it in advance. The next chapter, law changes and stimulus. So this is one of those categories that we would consider a 5. Can you change real estate laws sufficient enough to where you'll cause either great help or great harm? And the answer is absolutely. Just think if you wanted to change Prop 13. That would be an issue. So this is a Category 5 issue, and you also have to look at, from a historical perspective, are we likely to get more favors from law changes or more detriment to real estate? So that's what this is going to talk about, is where we see the direction heading, where's the sentiment for this chapter. And we have to take that in context and say, okay, if those changes are negative, then we have to put that in part of our formula and say, okay, that we have to pay attention to that. Next chapter, immigration changes. Doesn't look like anything's really settled on immigration, but immigration is a big deal. Maybe not a Category 5, but in 1986, when Reagan had immigration changes, it certainly stimulated real estate. One of the problems for immigration this time, if in fact we do change the rules and some kind of immigration reform passes, is that California is definitely one of the largest states with undocumented immigrants. And so you'll either have a big benefit or you could have a big negative, and that's what we'll talk about, because in this particular case, with lending restrictions as they are and the new Obamacare law in place, California could be the recipient of a whopping bill. And so we're going to tear this apart and take a look at it and say, okay, if this happens, then this is the likely outcome for this category and its effect on real estate. Foreign buyers, they're a pretty good sized participant in California. And it basically comes from two countries who have enormous real estate bubbles. So we're going to take a look at the Japanese bubble of the 80 range and how that in the 80s and how it affected California real estate. We're going to translate that to the bubbles that are in Canada and China, and just take a look at the impact if something happens to those prices, and we're going to show you where those prices are, how that'll impact California's market and what kind of buyers will disappear from our marketplace. First-time home buyers, this has been definitely a big drag on sales. This chapter deals with the likelihood of them reemerging, talks very definitely about all the debt that they have and the difficulty in them qualifying. There's an amazing chart that shows the percentage of first-time buyers under 30 that have full-time jobs. And so I've just found this very interesting to, of course, do all this research. I'm the one that learns more than anybody. Chapter 8, lending. We'll be interviewing in the next couple of weeks a lender that I trust. He's going to talk about all the changes that have taken place, and there are quite a few. We're going to talk to an expert that he's recommended about the direction of bond prices and interest rates. And this gentleman is considered an expert by the people that are in the lending world. And his opinion of where interest rates are going, I think, will be very, very interesting to all of us. Next chapter is household formation. So this is a Category 5 chapter in where we end up, what type of household formation, how different it is from the past where we have single households versus married and married people with children. This definitely has an impact on how many households can afford a house, and it's very different than it was in the past. Next chapter, California migration. In the past, this has been a Category 5, and it continues to be that. And so this is one of those dominoes that we have to have fall for us to have what we consider a true comeback. One of the things that happened in 2012 and 13 is we had price increases, and it was on the backs of lower and lower inventory and on the backs of volume that was really from a one-time buyer. And so the charts that normally told us that a comeback was coming didn't mature, and we need them to now. And this is a very important chart for California. Is migration going to go in a very positive direction, or is there something that's going to get in the way of that and prevent it? Next chapter, construction and its impact on real estate. Definitely in the Inland Empire, this is a very big deal. This industry is still not producing anywhere close to what we have in a boom. And this chapter kind of is perfect for that discussion, is how is 2015 going to be over 2014? Well, construction of homes in Riverside will be more in 2015 than 2014. But then you take a look at a historical perspective, and it's probably still down 80%. So that's what this report is doing. It's going to say, okay, year over year, this is going to be better. It's going to add contribution to employment. But again, in perspective of what it has done in the past, it's still behind and has lots of catch up to do. Chapter 12, commercial real estate. One of the most important things that I discovered, that this is definitely, first of all, a mixed bag. You have hotels and you have commercial real estate and office real estate. There's a category of office real estate where you still have prices that are close to the bottom of the range, more than half off of the peak of the last time. And you have industrial real estate that's all-time high. And in one report that I read, and we'll talk about it, there's an area of California that's actually the #1 destination place in the world for industrial real estate. So I find that that diversity is very important to understand, especially if you're intending to change seats and buy some commercial real estate. There's certainly opportunity in that space. Number 13, employment. This is a category 5. Usually driven by construction in California. So we'll take a look at this year over year, and then from a historical perspective, how is it going to benefit real estate? Is it going to be a driver? Is it going to be full-time jobs that we end up getting now? There's a very interesting chart in this chapter that shows kind of a reversal of something that's been very negative, and it's about to become very positive. So this is a category 5, and if it turns very positive, that'll be a big deal for California real estate. Affordability, again, this is one of the most interesting topics in this report, because one of the things we discovered in 2007 was that affordability could go way below 17 if there was systemic stimulus. So could you allow somebody to buy a house they really couldn't afford and a lender not care? Yeah, it turns out they would. And so therefore affordability dove down to a number that we didn't anticipate. On the flip side of that coin, is it possible that you could restrict lending so much that instead of 17% affordability being the end, it's a much higher number? And the answer is yes. And so this affordability chart can definitely get affected by other chapters and other decisions by people from the lending world. And it'll be very interesting to see how this plays out. I'm still a big believer that this is what I call a catalyst chart, that if this chart gets to the end of its available affordability, whatever that number is, that it's going to have an immediate impact in the next 12 months and create a very negative market. So this is why this is important to understand. Are we at the affordability range for this cycle? Or are we going to continue to do what we always do? And if that's true, we need the help of policy decisions by lenders. So it's going to be very interesting to see what happens. There's articles now being written. There was one I just read this morning, and this is from Julian Castro, Secretary of U.S. Department of Housing and Urban Development. He told an audience at a national press club that it was time for the nation to remove the stigma promoting homeownership. And this is an influential guy. Underwriting standards are too strict. We went from one extreme where it was too easy to get a loan to another extreme today where it's too difficult to get a loan. Strong, sensible middle ground where we have good safeguards in place so we don't slide back to the past, but at the same time, folks who are ready and responsible to own a home can get access to credit. So if that's the sentiment change that's going to take place in 2015 and beyond, that's real important to this chapter called affordability. Next chapter, interest rates. A lot of discussion. Harry Dent will be on. I'm interviewing him tomorrow. He has a new book out, and of course it's a very negative outcome, but it'll be interesting what he has to say about interest rates. I was watching the chart today of the 10-year T-bill. I talked to Kerry Pierce, my lender, asking him a few questions, and there's very definitely mixed opinions of where interest rates are going to go. The predominant opinion that they're going to go up, and if they go up, it's going to affect affordability, and if you're in an area that's already priced to the max in payment and you have an interest rate hike, there's only one part of the equation that can come out of, and that's price. So this is an important chapter, but a very difficult one to figure out where the direction is. But we're going to do our best on that. Number 16, foreclosures. What's next? We've been declining in foreclosures over the last few years. Again, a lot of this was manufactured. So we should have had a much higher rate of foreclosures due to our delinquencies. We prevented that by just not foreclosing on people and amending their loans and so forth. But there's some very knowledgeable people in this space that have the ear of hedge funds who think that 2015 will be the beginning of the next downturn. We'll be interviewing some of those people in the next few weeks to get their opinion of why they think that's true. And I'll give you my opinion if I agree with them or not. But foreclosures, if you have too big a mix, we know that that's not healthy. There's a chapter in typical household budget. I found it very interesting when I looked at several examples of household budgets and room for discretionary spending. And I looked at the estimate they gave for certain categories, and one of them was healthcare at a percentage that's completely unrealistic. And I guess this is where I wanted to see where the typical household budget had room for hikes in price, hikes in interest rate, and what they would be able to afford in a real estate payment. Sean O'Toole, good friend of mine, I respect his opinion. He's completely convinced that the household budget can't sustain more dollar payment, and so we are toward the peak of our price structure. So we'll see. We're going to tear this one apart and take a look at it, because one thing I know that is certain is that we are going to have cost increases for certain things, and one of them will be healthcare, and we'll talk about that. It's nice that we're saving $20 a tank full on gas, but it'll quickly find another hole, and it won't be discretionary. So we'll talk about that. Chapter 18, sales and inventory charts, not exactly telling the entire truth. That started years ago when we had inventory decline, even though delinquency soared. So we had an inventory hole that started to happen. We weren't foreclosing on people, and as that chart got lower and lower and lower in month supply down to week supply in some areas, we had unnatural price increases because of that. We had sales that were very interesting. We had sales charts that looked healthy, but if you put it under a magnifying glass, you'd see that were really driven by cash buyers and foreign buyers and hedge fund buyers, and that accumulated to a number in the chart that looked pretty okay, but some of those groups have curtailed what they're doing. And so 2015, we're going to have to live with the truth. Who really can afford to buy a house, and are they willing to do so? And category 5 is chapter 18. If sales improve, if people can get a yes answer from a lender, then the real estate market will be an improved place. Chapter 19, hedge funds participation. Here's a good question for hedge funds. Would it be easier to accumulate properties or get rid of them? And that's a real important question, is if they want to get rid of them, they can get rid of them at a much faster pace than it took them to accumulate. One of the things that we found out as we did the study over the last few years is we were concerned about how much did they own. And we really broke it down per year. Okay, well, they really were a buyer at only between 2 and 4% of inventory. But now that that's gone on for years, they've accumulated a very large percentage of a year's volume of sales. If they exit at the same time, they could become a market maker all themselves. That wasn't true in the buying so much, because they bought at a very methodical pace, although they made offers on everything. But if they exit, and there are some signs that some of them are going to, that'll be an interesting outcome. So that's why we wanted to have this chapter in there. When we talk about the next two chapters, California budget and U.S. budget, the main question is it likely that our taxation and real estate laws for both U.S. and federal will be more kind to real estate? When you look at the U.S. budget, it has that spending category where it's your choice. You know, how do you spend the money? That category of discretionary spending is going to show that it's going to go in big decline because the mandatory spending is going to go up. And that's true for California as well. So for this category, what they're going to be doing both in California and the United States is they're going to be looking for a place to get revenue. And unfortunately, real estate is one of those targets that's been treated very favorably. And so these two chapters look at this from a historical perspective and say, are we going to continue to have the goodies that we've had before, the $250,000 or $500,000 gain when we sell a residence, and the interest rate deduction where it's at and so forth and so on. So these two chapters can turn into Category 5 if it goes in the wrong direction. Next chapter, I'll discuss why I'm considering, and I'm not considering it anymore. I am exiting with some of my chips, and we'll discuss why I'm doing it, where I'm going to, the type of inventory I'm interested in, and we'll just save that all for that day. How close are we to the end of a peak market? So we have discovered probably 5 proofs, if you will. So we'll put to the math to all of those proofs. Where are we in this cycle? We break it down per county. Very interesting charts have emerged in this chapter, and I'm excited to share. One of the charts shows the greatest spread ever between a certain type of inventory and another type of inventory, and that I found very interesting, and in fact is the hole that I'm going to crawl through with a great majority of my money to take advantage of the hole that we found in this this chapter and the chapter prior to that. We'll wrap up with wild cards too significant to ignore, and those are outside of the world of real estate. It could come down to a terroristic event. It could come down to odd things happening in Russia or the Eurozone. There's just a pile of those things that we have to keep our eye on and say, okay, is that going to change our game as California investors so significantly that I have to make a new decision? And so it's just important to have that mindset, is that you can't just concentrate on California. You have to have a much broader scope now, and we'll try to cover everything on January 31st. I'm very excited about this report. It's a document that I'm proud of, and I'm glad Aaron can help me put it together. Nearly 300 pages, so it's a very aggressive attempt to cover the most information in that time period. For those of you guys who have come to our reports, I hope you think it's a no-brainer. I don't think you'd possibly be able to come to these conclusions on your own in the same time frame. So we're excited to have a very good group of people already signed up, and I'm sure that many of you will be joining that. We're only going to do it one time. So if you don't get in this Saturday, January 31st, I just won't do it another time. Any other questions? Not yet. Interesting.
Well, they didn't know they could ask.
Oh, they didn't know. I thought I said they could.
Yeah.
Okay. If you guys have any questions, feel free.
There's a discount until the end of Monday.
Okay. There's a discount available till the end of Monday. And what is that?
It's an early special of $100 off.
An early special of $100 off, and the price is?
$597, and then after it's going to be $697.
Okay, it's $597, and then after that it's $697. Okay, we've been asked to do undue stimulus again. Undue stimulus is something that occurs that stimulates price and volume. So the examples I gave before were where you had the lending world say it's okay to buy if you can't qualify, if you don't have a job, don't have any assets. That was undue stimulus. It allowed prices and volume to soar. When we weren't selling anything, we said, let's give them an $8,000 tax break. That was undue stimulus. It created volume that shouldn't have happened and basically stole volume from the future. So undue stimulus is important to recognize, okay? But reverse stimulus is equally important to recognize, because when that happens, you can expect things to get worse than anticipated. Case in point, FHA doesn't loan to people with below a 600 FICO score, and before it was a big part of their business. that's reverse stimulus. So that's what we have to look at all of these categories and say, in this category, are we going to enjoy undue stimulus, which is a positive impact on real estate, or reverse stimulus?
Where are you going to be investing in 2015?
Where am I going to be investing in 2015? I'm going to tell you that day on the 31st. Yes, the proofs that we're going to be talking about, yes, we do the math on all the things that we've done before, just to see where we are. We add a piece of that every time I discover something, another aha moment where I say, okay, look at that, and this time's no different. Yes, this is going to, the question was, we're going to have a clear and concise answer is what to do. Yes, you're going to have a very concise answer as to what I'm doing. You can decide to do it or not, but you're going to know exactly what I'm doing, and you're going to know why I'm doing it. Okay? The whole I'm going to crawl through, we'll discuss on the 31st. It's in the last two chapters, and maybe it was there before. I just didn't recognize it. But to be honest with you, I think it's very unusual that it's occurred, and we accidentally found it. We're doing a chapter we'd never done before, and when I looked at it, I went, oh my gosh, I can't believe that.
Reverse stimulus.
Reverse stimulus, again, is something that's really not normal, but it creates a negative. We all have experienced that. Military base closures in 1990 for California. That was reverse stimulus for real estate. And so that would be one of those things. Reverse stimulus, let's say you said Prop 13, that's out the door. That would be reverse stimulus. It would have an immediate negative impact. You can't sell your house, your residence, and make $500,000 non-taxable anymore. That would be reverse stimulus.
Most of the folks out of state. Can you purchase the book after? Shadow inventory of foreclosure still huge?
The question, shadow inventory of foreclosure still huge? From where it was, the answer is no. From a historical perspective, is it much bigger than normal? Yes, it is. The theory, though, is that this bulk of inventory, and we will interview a guy that is very well respected, that he feels like the inventory that's going to cascade into the marketplace isn't so much the people that are upside down or the lenders already own it. He is very concerned about the large amount of properties that have been bought by investors, hedge funds, foreign buyers, that it's going to cascade into the marketplace once this thing reverses, and that's going to create a huge negative. That's going to create another huge pile of negative equity positions. I want to interview him as soon as possible, because I think that's, even though whether I agree with him or not, I want his opinion because I know he has the ear of a lot of people. And you know what? I'm always trying to learn. I don't assume I know everything at all.
How are you handling taxes?
How am I handling taxes? I pay through the nose. You know, most of our investments, when you buy and sell a property, you can't 1031 exchange. But if you're asking me if what I'm selling, am I going to 1031 exchange? The answer is yes.
Can I do something?
Aaron's going to take it for a second.
You guys are asking a lot of questions. It's hard to keep up, but there's several coming up, people that can't attend live. So I highly suggest, if you can attend live, do. If you cannot, consider buying it now, because we're only making so many copies. After the event, we'll ship them to you. After it becomes a product, after the live event, we have to charge you taxes. It's going to be $597 on the website after the event, so you'll end up saving some money if you sign up before the early bird special. We are recording the event in both video and audio. We're going to use the portal. That way you don't have to end up downloading anything after. We're not taking up precious space on your iPod, your iPad. Our mobile-friendly website will take care of all that for you. if for some reason you can't attend live but you want the information, you could even send somebody in your stead and they can give you the information afterwards. Just some thoughts that if you're not going to be able to attend on the 31st yourself. Okay?
A couple questions are asking, is this going to be in transcript form?
There's the print book, but not.
Yeah, that's almost, honestly, it's just not possible to put that together. This is a book that's almost 300 pages that has 400 charts and speaking points, and that's why we're recording it, because no, you're going to get, first of all, being at the live event to me makes the most sense, because you're going to understand, I think you're going to understand a lot better if you hear me speak live. You also are going to get advantage of the questions and the challenges that will be presented to me in real time. So I just think, unless there's no way you can attend, it's a much better event to attend than to get later. That's my opinion.
Apartment building investing.
I'm sorry?
What about apartment building investing?
You know, apartment building investing, again, that's not an expertise of mine, but if you ask me, I've talked to people that are very knowledgeable in that space. They are happily selling to people that think it's a good time. So, no, I don't think that's probably a market that I think has a lot of upside and could certainly have reached its price peak. Question from a historical perspective, how long is the California real estate cycle? It's a very inaccurate answer every time. So there is no, well, at this last 10 years and this last 5. It doesn't work that way. What we do is we take a look at a series of charts, and when they mature, it's over. And one of the things that we did last time we did a report is we said, this is going to end at some point, and this is the math of how it ends. So we didn't tell people when it was going to end. We told them the methodology so they could understand it themselves. So that's part of that's true. It's just that you would want to know the math of it. So you can take a look at your area. Let's say you're in LA and I'm in Riverside. Your ending could happen earlier or later than mine, and you'd want to know it. So we've done the math for all of those areas. And again, getting out in time is serious business. Getting out early is probably smarter than saying, okay, well, gosh, if it's going to peak in November, I'll sell it October 1st. That's not a good idea. Yeah, that's interesting. Question was, there's a lot of demand in the Bay Area from China. Not only is there demand, you have to understand the mentality of that demand, and we will talk about that in the chapter on foreign investors. Because when you make a fortune where you are and you move that money to a new location, it's human nature to expect that you're going to have a similar result. So you're not very careful on how you spend that money, and you give a market a false sense of demand. So that's, once again, that's what we were referring to. So you see a chart and the Bay Area's got no inventory and the prices are booming, and you go, wow, this is going to continue. Well, it depends. It depends on who the participant is and who the participant is next. So if you came from China with $4 million and that was a 1,500% return on what you bought, and then you buy something else and you have to sell it to somebody that has a job, that could be a problem. So yeah, that's why we're covering that chapter, because you can't get caught up in those areas that have that money that's poured in and made most of the gain happen because people came in with money that they couldn't wait to spend.
Could you cover affordability rating? Did we hit 17% in California?
No. Okay. The question was, are we at 17% affordability in California? No, we're not even close. We're about 30. But the question is, will we get to 17 given the restrictions of lending? If you have the current policies in place, the answer will be no way. So the future of affordability is really going to rely on somebody making some common sense decisions, like I read that article today. And if that takes hold in time, then you may have a pretty normal affordability emerge. But again, that depends. So this is a moving target with a lot of pieces. This isn't, okay, let's just wait and watch and see what the affordability chart does. That's the whole point of this report, is that chart can be trumped by other activities that are out of our control, but we can know they're happening because we can watch them, okay? So anyway.
Lower insurance premiums on FHA, positive?
Yeah, the question was lower insurance premiums, FHA. Absolutely. That's one of the reasons I'm going to talk to Carrie Pierce as a lender. That's one piece of the puzzle. Having a 3% down loan for Fannie Freddie at their loan limits, that's another positive. So, yeah, we're starting to have some positive emerge from that world. Is that positive for real estate? Absolutely. Is it necessary for us to move beyond 30% affordability or to move down? Yeah, it is. You guys have to take this really seriously. We had 2014 that never has happened before with a set of charts we went into it with. Something caused us to have a blah year, and it's either going to reverse or, in fact, is the first year of a downturn. So that's what this is about, is that chart telling me I'm over at 30% affordability, or are there other reasons? Okay.
Do you expect Moreno Valley to flatline?
Do I expect Moreno Valley to flatline? To be honest with you, it's going to depend on a couple of things. One thing that Aaron does is he's very connected to cities and what they plan. There's some major construction projects that are being talked about, and when you ask specifically about Moreno Valley, the answer will be, if those in fact materialize, you'll have a very different Moreno Valley than you've ever had. So maybe that's not the answer you're expecting. But in the particular inventory that I have, I consider what I own more of a speculation than investing at this point. The effective equity lines coming due. You know, what's interesting is that most people have equity. I did have an equity line that was coming due, and I sold the property. That happened to be a residence. So if you have equity and you have an equity line coming due and you can sell it, that's great, which most people can at this point. I don't see that being as a big factor. If you do have an equity line that causes problems and causes a foreclosure, I don't think it's going to be in sufficient quantity to be a disaster. I just don't see it. I see a lender maybe rewriting to a different type of credit line, but I don't think it's going to cause a tremendous amount of foreclosures.
Where do you see oil going?
Where do I see oil going? I haven't got the foggiest idea. You know, it's one of those things that I can tell you that I have people that I know that are in the oil industry, and I asked them if they had anybody that they listened to tell them that was going to be cut in half inside of 6 months, and the answer was no. So I can't comment on that. What's going to be interesting is to see if it has is why it happened. I'm very interested in asking some people that question. Why did this occur? Is it because the demand side is weak, or is the supply side now outpacing the demand? Because that's a very important question, because we're figuring out how to create more oil supply. So it's interesting how big of a deal small percentages make, just like California migration. In the 90s, you know, the worst year we had, we lost 100,000 people, and we were 30 million people in population. You think, well, what a big deal that is. You know, is that really going to cause a problem? Well, yeah, it really did. Well, the same thing with oil supply or oil demand. It doesn't take a swing of 20% to cause a big problem. It'll be interesting to see what the outcome of that is. It's not just oil. Oil's impact on interest rates and other commodities. Profits for some types of companies and the devastation of others. So, to be honest with you, I'm not sure. I considered putting an oil chapter in this report. There wasn't space for it. But the website, within a few months, will have an oil chapter that I will put into the website. Okay. What do I think of diversifying into a 1031 exchange into multiple Delaware statutory trusts? I think most people are not going to understand that. So you know what? I'm going to leave that. Just saying, 1031 exchanging to inventory that's investments rather than speculating is a good idea. I think maybe what you're talking about is that you're not really in charge of those trusts. You're going to 1031 in exchange to a trust that buys real estate, and that exchange is acknowledged as you're doing like for like kind. That's really beyond the scope of what I want to try to answer in the next few minutes.
Would you sell a primary residence and rent?
Would I sell a primary residence and rent? My answer would be no, but it's not because of math. It's because it's a primary residence. I had the same decision on a residence that I had in Riverside in 2005 and 6. I knew it was going to go down. It was worth $1.2 million. I closed escrow on it at 705 2 months ago. Am I happy that I kept it? Absolutely. I kept it as a residence. It wasn't an investment. So if you're asking me, will the math work out better? The answer is it'll depend. And so when we get to the 31st, we'll talk about those areas, and you'll see charts that'll tell you that when you own a property in this city, you're speculating, not investing. Okay?
With growing income inequality in the country, don't you think it would be better to invest in higher homes?
With the growing income inequality in the country, do you think it would be wiser to invest in higher end homes? No. The right question was, do you think it would be better to speculate in high end homes? Because the problem with high end homes is there's no solution other than usually getting out. And we get blindsided all the time thinking that that's going to continue. Those high areas get hurt too. So I really consider that, just because it's working out, and I know lots of people that are doing high-end homes and hitting it out of the park. That's one of the reasons this report's important. I want them to recognize what they're doing is gone past investing to speculating, because there could be a time where those people take a hit and can't afford the properties. That's my take on it. The question was, as a realtor, I run into sellers who they don't want to sell because prices are going to increase, is their opinion. Usually when their property increases, guess what? The property they're going to replace it with is increasing too. So I guess I don't get the theory there unless you can buy wholesale. To me, it's the same thing. So what? Your house goes up 20%, the one you eventually buy went up 20%. If you want to move, I would just move. I don't think price is the important issue. I think interest rates are. Get a 30-year mortgage today at 3.75%. I think I was told by Carrie, no points. That's the deal. I don't care if it goes down to 3, it's still a deal. There'll be bragging rights someday for having a 30-year mortgage start with a 3, and I think your location or the price you paid probably are less important than locking up that financing. What's the longest time a flat market has occurred? California went from 90 to 96, pretty flat. We've just gone from, well, we've played catch up, so we really haven't had a flat market. We've had a market that's risen from way below replacement cost. So the stretch that I mentioned, California 90 to 96, the longest flat market. We're running out of time. One more question.
Sure.
One thing, one question that was asked, one thing that's interesting is the speed of information that's available now and how that plays out. There's also speed of misinformation. So people get on a bandwagon and it travels very fast. That's why I honestly like the reports that we've put together. Nothing's emotionally driven. And usually the end is very similar to the end that was before. in this report, we have really considered a lot of different facets to a lot of moving pieces. So I think we're very much more capable of accurately saying, okay, we're going to watch all these categories for important events, and we understand that there's connective tissue between a lending policy decision and that affordability chart being able to live its full life all the way to 17%. So I'm not too worried about the speed of information. I think what we're about to see in the next few years will provide opportunity for people that understand what they're doing, and then they switch from speculating to investing. Okay, I'm going to let Aaron wrap up. Thank you, guys.
All right. Hopefully, technology willing, we captured all of this. There was a few more questions about the reverse stimulus and what that was. It's going to be up hopefully in a couple of hours on the website before we head to Palm Springs today. The norrisgroup.com/2015. Again, there's a discount until the end of Monday, which is a holiday for some of us. So check that out. And if you have any questions, you can always email me at Aaron, AARON, at thenorrisgroup.com. I thank you for showing up. That was a huge group, and I tried to keep up with questions as much as I could, but hopefully you'll come to the live event and get a lot more time to see the charts and get the answers for yourself or ask questions there. If you do plan on attending live and you're going to stay downtown Riverside, the Mission Inn, the Marriott, and the Hyatt are great locations. We are going to plan a networking event Friday night if you stay the night, possibly including a docent tour of the Mission Inn, which is a lot of fun. So if you are doing that and you sign up, you'll get an email on that next week. Okay? Thanks so much, and thanks for joining us for lunch, and hopefully we'll see you on the 31st.